Thanks for the organizers for inviting me to give this presentation. I'm going to do something different. I'm going to kind of combine a bunch of kind of research that I've done in the past and kind of provide you some facts about dollarization in emerging economies. And then finally, I'm going to conclude a little bit with, okay, what are the implications for optimal monetary policy? Okay. All right. So we know that, when in countries where things don't work so well, when there's lots of instability, private agents are very creative and they're going to try to come up with kind of tools to overcome the instability. In emerging markets, usually kind of nominal volatility is a concern. So alternative currencies emerge, and typically this is going to be the US dollar. Okay. And this is gonna, it's gonna be used sometimes as a unit of account in terms of, pricing decisions, in terms of, storage of value, in terms of, should I, save in dollars or in my local currency, and even sometimes in extreme cases also as a means of payments where we literally switch and start using another currency to make payments. Okay, so we know that, at least I'm going to try to show you that dollarization is going to be important because it's going to affect the pass-through of exchange rates to domestic prices. It's going to affect the distribution of household wealth because not, all households save in the same kind of way. And it's also going to affect the ability of monetary authority to affect the economy. Why? Well, at the end of the day, monetary policy is very simple. It's affecting one nominal price. And we are just hoping that changes in non-nominal price affects a real price. Okay? And that's what we have. So it really matters, the units of account of all the other prices in the economy, because literally you are only affecting one nominal variable, expecting to affect the relative prices of these other goods. So today I'm going to kind of focus on three kind of broad questions. First, uh, I'm going to present facts about dollarization of prices in emerging markets and importantly, why it matters. Okay. We're going to have some evidence about this kind of pass-through, not only to prices, but we're also going to have data on quantities. I'm going to show that pass-through is very different to these different goods as a function of the unit of account. I'm going to say something about dollarizations of household portfolios and kind of revaluation effects of exchange rate movements. And finally, I'm going to discuss kind of briefly some theory about what are the policy implications in terms of monetary policy, and in particular, direct regulation of these units of account and store of value. All right, so let me start with the first question. So here I'm drawing on a project I had with my co-author Diego Perez, that at some point we were kind of lucky enough that a large kind of e-trade platform in Latin America decided to give us the data, okay? And, usually this is kind of hard to find, in particular information on, units of account in a domestic economy. We have much better data in international trade context. We don't know so much about what happens inside countries, okay? So this is, as I said, is the largest e-trade platform in Latin America. It basically operates from Mexico all the way down to Argentina. And here I'm showing you kind of the share of prices in three different markets that are denominated in dollars. And these markets are going to be the goods markets, okay? Vehicles, so this is going to be purchases of used and new vehicles, and the real estate market, okay? So both for rentals and for sales of houses or, commercial real estate as well. And as I said, we have data for a bunch of countries in Latin America. We see that overall, on average, around a quarter of prices are quoted in US dollars, but there's tremendous amount of heterogeneity across countries and markets, okay? So if you focus, for example, on the goods market, we have countries like Nicaragua where 84% of prices are listed in US dollars. And then you have countries like Mexico, which are around 0%, okay? Um, then the other surprising fact is, dollarization in the real estate market is quite severe, okay? Um, and we think that this is also kind of important because the one kind of peculiar feature of the real estate market is that the unit is waiting for a buyer for a long amount of time, okay? Versus in the goods market, the vehicles, these kind of selling times are much shorter, okay? And this is going to connect a little bit with, kind of the desires for kind of price dollarization, which is going to be about, you know, when I have inflation volatility, I'm really looking for a cheap indexation scheme, and the dollar is going to provide that. Okay. There are some other countries where, for example, Brazil, Chile, and Colombia, they have zero dollarization, but that's by direct regulation. The surprising thing is that this desire for an annexation scheme is out there. Why? Well, because Chile, even though they prohibit price dollarization, they have their own special unit of account that is tied to inflation, which kind of it's a imperfect substitute of price dollarization. So, but there seems that there is demand for these types of indexation schemes. All right. So now let's kind of look at a little bit of kind of heterogeneity of which prices are more dollarized than others. So the first thing here, I'm just showing you a simple kind of scatter plot of data from Argentina and Uruguay. When the x-axis, I'm just showing the decile of the price, like literally the unit value of the goods. And on the y-axis, I have the fraction of prices set in dollars. And you see that clearly there's a strong positive relationship. Of course, there are things that, electronics around here that are very expensive. There are some kind of reasons why we might expect that they are quoted in dollars. And then here you might have some things that are kind of cheaper and locally produced. The surprising thing is that when you can look at very narrowly defined categories of goods, I don't know, like electronic accessories for computers, something like that. Clearly, I mean, at least in the case of Argentina and Uruguay, we don't produce anything of those goods. You see the similar relationship. So that kind of says that there are kind of factors and the typical ones, like the chances of the products being kind of imported, that might also affect this decision. In particular, one thing that I'm going to show you later with the kind of household asset dollarization is that most likely households that purchase these types of goods are not the same as households that purchase these goods. Okay, and they are going to be different. Okay. Now, in this other, figure, I have kind of the typical variable that we kind of think should be important for price dollarization, which is, what's the cost of this good, okay? And in particular, is the cost denominated in foreign currency as well. So here we try to produce a tradability index for each individual good in this platform. And this kind of captures that what is the chance that this product was imported from abroad. And again, you see that there's kind of a positive relationship between, basically we are thinking that if the good is quoted in dollars, most likely the seller wants to kind of pass that kind of volatility or risk to consumers by also quoting in US dollars, and in that sense, avoiding any kind of currency mismatch. Okay. Then the other kind of important variable is financial considerations. Okay, so we know that usually larger firms have higher access to dollar borrowing. In part, they want to exploit the fact that dollar borrowing tends to be cheaper in some of these economies. Of course, we don't have information on kind of balance sheets of these sellers, but here we're trying to kind of use a very crude proxies, which is just kind of firm size. Okay, and we do see that in some economies, in particular in Uruguay, and across all of these markets, there's kind of a strong relationship between firm size and the likelihood that the quotes are going to be in US dollars as well. Okay, so then we wanted to understand, okay, what are the typical kind of causes for price dollarization? And we couldn't run regressions because at the end of the day, we have, it's a one cross section. I mean, we have lots of micro data, but at the country level, it's basically one observation per country. So I'm going to show you some correlations. Okay. So the first thing that pops out is that deposit dollarization and price dollarization are strongly correlated. Okay. Now, the $1 million question is, which one comes first? Is it because for some other reasons, households want to kind of shield their savings and they save in dollars, and then the seller says, look, I can avoid my mismatch by just offering the same price quoted in the same currency, or it's the other way around, that for some reason, sellers, they want to quote in dollars, and then households endogenously respond by saving in dollars, okay? The other thing that's kind of interesting, we found that like size by itself is negatively correlated. So, smaller countries tend to quote things in dollars more often. You would imagine that it has to be because of kind of a trade openness channel. But then when we look into that by itself, you see that this is not as highly correlated. It is true for goods, which is what you would expect because we don't import houses. But you see that size plays a bigger role independently of the market, where trade openness is particularly concentrated in the goods market. Okay, so it seems that size matters independently of whether kind of the cost of these goods is quoted in dollars as well. The one thing that kind of surprised us, and we tried a lot. I mean, here you see two numbers, but we try many of them, is that there's a very low correlation between inflation history of a country and current price dollarization. Okay, and I think there are two reasons. First, I'm going to show you a little bit that dollarization is very persistent. So there's this concept of hysteresis in dollarization decisions. So it could be that the country today is doing very well, but for some reason there are mechanisms that kind of propagate the same decision over and over time. But we still don't see it with inflation rates 20 years ago. Okay. The other thing that is also kind of puzzling is that the exchange rate volatility, I mean, it is negatively correlated with dollarization. If I'm using another unit of account and that unit of account is also very volatile, then the chances is that I might not have strong incentives to use it, but it's not huge. I mean, it's still a correlation of 0.3. The interesting thing is when you do combine inflation, average inflation, and the exchange rate volatility ratio. Okay, what matters is not if, is my local currency stable or not, or is the foreign currency stable or not. What matters is the relative stability of these two currencies. Okay, and the moment I mean, it's a very crude measure, but the moment you combine these two measures, then you see that correlation is much higher. Okay, so countries that have high inflation but relatively stable exchange rate are going to be more likely to be using the dollar as a unit of account. Okay. All right. So what are the theories that we have to think about this? I'm going to kind of give you a more technical view, and then I'm going to give you a simple intuition for this. Is that producers, they want to use the currency that best tracks the optimal flexible price condition non-adjustment. What does it mean? If I was able to change my price every 5 minutes, currency choice doesn't matter. And every time I would be selling something, I know the exchange rate, I know my cost, I know everything. And because I can adjust it every 5 minutes, currency choice is truly irrelevant. So what is the problem? Well, that we don't, change our prices every 5 minutes. So typically, especially in an international trade context, price stickiness could average around 11 months. So these are long periods in which firms are not actually updating prices. So then what do I do? Well, I know what would be my optimal price if I was able to adjust every 5 minutes, okay? And now there are two objects that are going to be moving around, which is what happens if I set my price in local currency in pesos, okay? Or if I do it in dollars. Most likely, neither of these two is going to be very close to my optimal, price, because these objects move for a lot of kind of other reasons. But what you're trying to do is just pick the currency so that your price in the local currency gets as close as possible to your ideal price. Okay, so for example, in a very simple context, suppose that the exchange rate is pegged, but there's kind of constant trend inflation. What you would like to do is maybe literally just grab the exchange rate, and that's going to provide a perfect indexation scheme. Okay. So then, as I mentioned before, in emerging economies, typically we care, about two problems: high inflation, okay, which means that if I set my prices in the local currency and I have inflation, over time that's going to erode the real value of my price. That's going to make the dollar more attractive if the exchange rate and inflation kind of keep track with each other, which at least in the medium run, that's relatively a good approximation. Now, we're also going to have that if you want a large pass-through of nominal exchange rate shocks to the prices. Why? For example, let's say um, you are selling cars and a big component of the car has imported intermediate inputs that are quoted to you in US dollars. Well, you don't want to create a mismatch between your consumer final price and your cost of production. So you might want to kind of pass that risk to your customers and quote in dollars as well. Okay. All right. All right. So then the question then is, does it matter or not? Okay. There's one part that it's gonna be mechanical by definition, which is what happens when you have exchange rate shocks. What happens to the prices of these goods when you convert them into a local currency? Okay. So that's what I'm showing you here, and we are doing this for 90 days just because, we were scraping kind of billions of prices per day, and at some point this was just kind of too big. Okay, so we're going to look at kind of relatively short horizons, and I'm going to be looking at the evolution of local currency prices after an exchange rate shock in period 0 relative to the evolution of um, prices of goods that were quoted in dollars and then converted into the local currency. Okay, and what you see is what you would expect. If prices in local currencies don't move, and if there is exchange rate movement, the price is going to stay the same. So the pass-through is almost zero. Then, if you decided to quote in dollars, because these decisions are relatively persistent and there's an exchange rate movement, what is going to be pass-through? It's going to be one-to-one. Okay, so that's what we recover. Is that surprising? Not so much. What was kind of interesting in this project is that we had data on quantities, because we were scraping this thing like every day, and we were able to figure out quantities sold on a daily basis. Okay, and here what I'm showing you is basically what happens to relative quantities of similar products that were quoted in dollars compared to that product quoted in pesos. Okay, what did we kind of uncover here? That demand is downward sloping. Okay, what we are saying is if your prices quoted in dollars have a one-to-one pass-through in domestic currency, households are going to naturally substitute towards goods that are quoted in the local currency. Okay, and we find it we find it in the goods market, in the cars market. We also find it in the real estate market. So for real estate, we don't see the transaction. The only thing we are assuming is that posting this platform is expensive. So the moment you kind of drop a listing from the platform, it must have been that most likely there was a transaction here. Okay, and we see it in all of these markets. So and the other thing that's kind of interesting is if we look at the kind of dollarization measures that we have from our data, they are very good predictors of aggregate pass-through using the aggregate CPI of a country. Okay, so it's not something that is just confined to this market, online market, but it seems to be a good predictor of aggregate pass-through. And then there's a kind of other effects that have been studied out there that we don't have much to say, but you always need to remember that there are kind of strong balance sheet effects on firms if, for example, debt is denominated in foreign currency, but revenues are collected in local currency. Okay. All right. So how am I doing in terms of time? Okay. All right. Now, the second point that I wanted to discuss is dollarization of households' portfolios. Okay. And here I'm going to be, again, also using data from Uruguay. It seems that these days Uruguay is becoming a Scandinavian country because it has data on kind of all of the different aspects of the economy. I think that this is almost the single survey in all of Latin America that collects data on household balance sheet, including information on the currency composition of assets and liabilities. Okay. And here there are two measures that I wanted to show you. The first one is just, if you look at monthly real income of Uruguayan household, this is in 2006 US dollars, and the probability or the likelihood that the household has a dollar bank account, you see that, for low-income households, that probability is close to zero. For kind of median households, it's already kind of 20%, but that increases all the way to 60% for the highest income households. Here also is a kind of a brief summary of what the typical household balance sheet looks like for low income and high income. And these are kind of the bottom and the top terciles of the income distribution. And what you see, first of all, there's significant heterogeneity in participation in these margins. What do I mean by this? Among low-income households, only 3% of them, they have any assets in foreign currency, and 5% have assets in local currency. And here by assets, I do mean liquid assets. Okay, so I'm not including kind of like the house or kind of cars. But around 30% of them, they have liability in local currency. And typically, as this was kind of shown in the kind of previous paper, there are very little kind of loans to households in foreign currency. Most of those are kind of reserved for firms. And then when you look at the kind of the overall kind of net wealth distribution among these households, you see that there are lots of zeros. Okay, so I think this might also be related to kind of some of the previous discussion that says, how do you do monetary policy when there is no Euler equation? Okay, when households, for some reason, either they choose or they don't have any other option than just be kind of hand to mouth and have consumption being equal to any source of income. Okay. Now things are kind of a bit different for high income households. At least a quarter of them, they have assets in foreign currency. I mean, it's not huge, but even among this group, there's significant heterogeneity. You see at the 10th percentile, they have around like $1,500, but at the top of the 90th percentile, within this group, they have around $40,000 in assets in foreign currency. They also kind of say a little bit more on assets in local currency, but you see that it's smaller than $4. And the interesting thing is that they have kind of a similar participation in terms of local currency debt, but maybe of course the amounts are slightly larger. Okay. So when you have this kind of large heterogeneity in dollar holdings across the income distribution, then the big question is what happens when you have an exchange rate devaluation in terms of the impact on wealth inequality. Okay. So what we did was kind of historically, there have been kind of similar exercises in the US. There's a nice paper by Matthias Dobke and Martin Schneider about the revaluation of nominal positions when you have an inflation shock. Okay. Here we try to reproduce a similar exercise by asking what happens, who are the winners and losers given this structure of the household balance sheet when you have an exchange rate depreciation. And this is what we have. So we're going to say, and at this point, this is pure accounting, right? There's no kind of behavioral responses. We don't know what happens to prices. We're just saying a simple question is, if the exchange rate depreciates by 20%, which is around kind of, the typical big devaluation in our sample, what happens to the value of households' net worth, okay? And what the first thing is, as I said, there's lots of zeros, just because there's very little participation in financial markets in these economies. And you can say that even among low-income households, they do save a little bit in US dollars. So, for a 20% depreciation, they might get like a 0.3 increase in the peso value of their balance sheets, which is relatively small, okay? Now, if you do it for high-income households, again, even among this group of households, you still get a lot of zeros, but on average, they get around of like a 3% increase in the peso value of their balance sheet. The interesting thing is that, of course, there's significant heterogeneity even within this group, because for some of them, there's almost a one-to-one pass-through. And, they experience a 16% increase in the peso value of their balance sheet. Okay. Okay. And the other thing that I forgot kind of to link a little bit is, when I mentioned this idea that expensive products are more likely to be quoted in US dollars, what we did in Uruguay was to say, we don't have the perfect information, so there was a little bit of imputation involved, but to say, okay, what's the relationship between household income and access to dollars, and what's the relationship between household income and the typical value of the price that they pay within narrow categories. And then we imputed this, okay? And then what we found, not surprisingly, is that, as I said, the households that purchase these goods are very different than the households that purchase these goods. Why? Because these are more likely to have dollar assets. Okay, so you could think that maybe part of this decision is driven by that. Okay, and in the last minutes that I have for my presentation, maybe I'm going way too fast.
You have 5 minutes.
Oh, fantastic, perfect. Okay, so the question here is, how do you conduct monetary policy when agents are choosing other units of account? Okay. At the end of the day, as said, what is monetary policy is a decision about a nominal price, okay, which really matters than, what's the unit of account and the store value, how those are denominated in the rest of the economy. So there are two issues. If you have dollar pricing, you're going to have problems with price stabilization. Why? Because I show you that the local currency and the dollar prices respond very differently to shocks. And particularly in these economies, exchange rate shocks or exchange rate volatility is a first order concern, which means that it's going to be harder to implement flexible price allocations, because the only thing that you might aim to do is to stabilize prices of goods quoted in local currency. But then at the same time, you have these other goods that are going to be, have prices that are going to be moving around a lot. Then you have also other problems when you have contract dollarization. Okay, and when I say contract dollarization, this could be kind of deposits or loans. That's going to pose challenges for this redistribution. So I'm going to mention a little bit this other project I have with Diego and with Risha. Okay. Here the idea was to say, look, we think that monetary policy can do good things in general, okay? But for that, you need to be able, you need to give the chance to the monetary authority to do it, okay? And the more contract dollarization that we have, we diminish it, that chance, okay? So, and in particular, the way we're gonna do it in this project is that, I'm not gonna give you the kind of the setup of the model, but I want to kind of provide the story. So suppose that we have bilateral contracts, okay? You're producing apples, I have oranges. And in a frictionless world, we can just say the contract, today give me your goods, tomorrow when I get my good, I'm just gonna give it back, okay? And we say, look, for some reason in the real world, we don't trade in apples and oranges. We have to do it in pesos or in dollars, okay? So then the question is, today you're giving me a good, with the promise that tomorrow you're gonna give me some other goods, but you need to quote that value in either local or in the foreign currency, okay? And we need to sign contracts in a way that we prevent default risk. So then we're gonna make a decision, okay? And then on the other side, we're gonna have a central bank that says, okay, given the amount of dollar contracts, I'm gonna choose inflation. I'm going to say there are two sources of, or two considerations behind the choice of inflation. One is whatever is kind of behind a typical decision behind monetary policy, okay? We did find that in these economies, inflation volatility is strongly tied to the volatility of fiscal deficit. So we're going to say, look, there's another motive that for some reason you're pressured to kind of, print some money to cover for the deficit. And that's going to be exogenous to the model. And that's going to be our source of variation. Are countries behaving well or are they misbehaving? But at the same time, the central banker says, look, there's a bunch of, let's say, peso contracts out there. There's a shock that makes the likelihood of default very high. So I can do something good. I can wipe out a little bit the real value of those contracts, okay? With the hope that I prevent costly default. Okay, but now you see that now there's a coordination mechanism. Okay, and what do we get about this kind of simple model is we have different type of equilibria as a function of what we're going to call this policy risk, which is as a function of how unstable is inflation because of other reasons. Okay, and what we find is, when policy risk is high, the best thing that the only equilibrium that we're going to have is that contracts are signed in dollars. Okay, because contracts is signed in dollars, the central bank doesn't do anything to alleviate this market because it can't. So it just does the typical thing that they would do. When policy risk is very low, now this says households understand that, look, inflation is very stable, so we have incentives to sign contracts in local currency. Also, because we are signing contracts in local currency, the government has incentives to do something good if there's kind of high default risk, and that decision is kind of self-enforcing. The problem is in the middle. When you have multiple equilibrium, that's kind of a pure coordination mechanism. Okay, if everyone is signing contracts in dollars, the government is not providing any insurance, and because of that, I don't have any incentive to sign contracts in dollars. But if everyone was doing local currency contracts, now the government is going to provide some benefits and increases the chances of me deciding to do the same thing. And it's a pure coordination problem. Okay, that's where the multiplicity arises. Okay, so there's kind of one way to de-dollarize this economy, which is through monetary fundamentals. Let's behave well. Let's not, print money to cover deficit. Okay, what is the problem with that? I think this, has been mentioned before. So here I'm showing you, for example, two experiences of Peru and Uruguay. Here I'm showing the annual inflation in red in these two countries, and the blue line is the deposit dollarization. From an inflation perspective, these are two stories of success. Okay, they clearly kind of stabilize inflation at low values, and you see that after that it doesn't move much. But clearly you see that the dollar deposits, they still remain very, very high. Okay, and you have this persistence. Why? Because we live in this kind of problem of coordination that I was receiving someone is paying me in dollars, and I need to pay someone else in local currency in dollars. But the best thing I can do is just keep matching the payments that I receive. Okay, and that's why I think that we have this kind of strong persistence in this decision. What is the alternative? Just straight regulation. We have seen countries like Brazil and Colombia and some of these other countries that directly prohibited dollar deposits. Why? Well, you can justify that in this intermediate regime, okay, which is we're just coordinating in the bad equilibrium. And the only thing you need to do is to provide kind of a small nudge so that households kind of convert to the best outcome. Okay, so I'm running out of time. So with that, let me just kind of conclude. I think that we have a significant incidence of price dollarization in Latin America. And I think from the conversation I had with students yesterday, it's kind of a more global phenomenon in emerging economies. We know that price dollarization is kind of strongly tied to other forms of dollarization in the form of assets and contracts. And I think that there are some kind of challenges if we simply try to de-dollarize by having kind of a disciplined monetary authority.
Thank you, Andres. Great. Thank you, Andres, for giving us a great overview on the facts regarding dollarization and also tying it with household heterogeneity, which I found personally very interesting. Okay, so we have about 8 or 9 minutes for Q&A. I'll go with Tanya.
Thank you once again for the presentation. I'm Tanya from Zimbabwe. I have a question on the issues to do with de-dollarization. You mentioned about 2 channels of de-dollarization, either by monetary discipline or through policy regulation. But most countries that have tried to de-dollarize, they've suffered problems to de-dollarize. For example, Zimbabwe dollarized in 2009. Around 2018, 2019, they introduced a local currency. and it tried to ban the use of US dollar by police, but it faced resistance. De facto, the economy dollarized. And the government found that it was now losing the battle. In 2020, it partially dollarized again. So it allowed the use of the dollar again. And also the government is paying civil servants in US dollar and also the local component. So we have the local component, which is the local currency and the US dollar. But the US dollar is taking more than around 80% of the transactions. So everything is dollarized. Then they tried to introduce several reforms in terms of trying to gain confidence from the public, but it's still failing. So they tried to introduce another currency, which is backed by gold and other precious minerals. But it's still, people, because of the yesteryear memories, they don't want to use the local currency. So how best can it be done? Because by policy it is failing, and also by discipline, I don't think by discipline it will work. Thank you.
All right. Yeah, that's a great question. So I think that in economics we have a very good understanding about how to lose confidence. I think we have tiny or like close to zero understanding how to gain trust. I think that there's a little bit of political economy involved there, more than economics itself. Um, yes. So I mean, in the examples that I'm showing you here, if you want this to kind of work, is you first need to show me that you can do this. Okay. So what I'm saying here is that here we are stuck. Agents are stuck in some kind of persistent decisions, but clearly, these countries first they did their homework. Okay. Um, and for example, I'm thinking, cases like in Argentina. So there are entire generations where they haven't experienced a period of stable and low inflation. Okay. So I think that the first thing you need to do is you need to convince that there's something better out there. Okay. And then when they see that and they say, look, you can't do this anymore, and they say, sure, fine. I mean, inflation is low anyway, so yes, I was doing this because my neighbor was doing it. Okay. So what you need is just some coordination. um, Now, yes, in some extreme scenarios where reputation is very hard to gain, um, I don't think that at that point is much about economics per se. As I said, is more kind of a political economy problem.
Great presentation. I have one theory-related question about the uh, equilibrium multiplicity region. If you were to look at this from the perspective of the Friedman rule, like the optimal monetary policy, is there a possibility of the Friedman rule being suboptimal in that region? To
Yeah.
to get rid of the coordination issue.
Well, I mean, there are other issues. So, I mean, here, what we wanted to embed in the model is um, a reason for why the central banks can do something good if contracts are in local currency. And the way we thought about this was this idea that you can just, um, if the country is in kind of close to like a kind of massive default, just lower the real value of that. And it's not kind of a crazy story. Even in the US it happened. I didn't know this, but um, around the 1920s, when there was a peg, there was a big concern in the farming industry. So that was very high. And you see the minutes in the Congress, and they say, let's get rid of gold. We can increase inflation and avoid a massive default in the farming. And maybe an economic historian can verify that. But these kind of situations they do happen. They don't happen often. It doesn't have to be that this is the main source of kind of or how monetary policy should be dictated. But it's more about, yeah, why should we deviate from the Friedman rule? Because of other things that could happen that we are not capturing in our standard models. Um,
Very quickly, very interesting. But let me just point out that in the case of Peru, actually the dollarization example is in fact a case of success, right? I mean, if you had looked at the data not ending at 2010, but ending at 2020, then you would have seen that the dollarization coefficient drops from 75% to less than 40% right now, right?
Yeah.
So I guess I don't know what the case of Uruguay might be, but the point is, in that case at least, dollarization not only has not been a main hindrance to monetary policy, and I'm going to be able to say more, when I talk about
Yeah.
monetary frameworks this afternoon, but also, it was the success of sound monetary policy that eventually brought dollarization down.
With the exception that there was one more policy implemented, which is that's so, and correct me if I'm wrong, but there was a law that says if there's a price quoted in dollars, next to it, it has to be that there is a price quoted in soles. Okay, so again, you need to do something, even if it's something as small as to say, you can keep your price in dollars, but next to it, you need to price in local currency. So you need to do small things to kind of maybe get out of this bad equilibrium and just, because it's a coordination problem. Individually, it's rational that I stick to the same decision, but if a law tells us we all need to do this, then maybe you can push uh, price setters outside of this equilibrium. That's the only thing I was saying, that maybe sometimes you need to help a little bit. It's not just do your homework in terms of low and stable inflation. Maybe you just need a small kind of nudge in the right direction.
Hello, Professor. This is Monzur Morshed from Bangladesh. I just wanted to ask one question regarding the graph. Here you can see from Peru in 2010, the degree of dollarization is almost over 55%. And for Uruguay, it's almost over 77%. But Peru's inflation is a bit lower than Uruguay, whereas Uruguay's degree of dollarization is higher. Why it's happening? That is the case.
That's a great. So, I mean, the one thing is also that Uruguay is a smaller economy. So I would say that, again, linking price dollarization and asset dollarization, I would imagine that Uruguay has a much kind of larger fraction of goods that are being imported relative to Peru. And maybe that's also what, why Uruguayan households decide to save more in dollars, maybe for purchases of durable goods. Um, but yes, in terms of levels, I don't know, in terms of, because in terms of like history of monetary instability, at least in the 80s, we were all kind of misbehaving in kind of similar ways.
The last one in before we break for lunch.
Just want to make a brief comment and just to follow on to Tanya's comment, which is it's much harder to go from 100% dollarization to 95% dollarization because there is no local currency, right? And so the nudges aren't going to work. If you have no local currency, you can't demonstrate you're having low inflation.
Yeah.
So that 100% dollarization equilibrium, I think Tanya's question is how do you sort of reintroduce a local currency starting from 100 instead of going down from 75 to towards zero? Almost a different question, right?
Yeah, so I would imagine some of these events are also associated with more like bigger political events that at some point society says enough, and we're going to introduce not just one reform, we're going to kind of reform the entire government, and maybe that provides credibility. I don't know, but I agree that I don't think it's just like, oh, everything else is still a mess, let's fix this one thing. I think it's just like a big package of reforms, but But I think I'm more of the view that those types of situations are more political than economical. Because again, we know from an economics point of view, we know how to lose reputation, but to gain it, this data says that you need to be very patient because it takes a long time. Yeah.
And on the note of reality, that more things these days happen to be political than economic, let us thank our speaker, Andres, one more time. And I'll also mention it's time to break for lunch. Hungry stomachs are beckoning. So we will be conference participants and if CD fellows, Williams faculty, you're all invited. Lunch is going to be served at the faculty club, which is about a 5 to 10 minute walk in that direction. Just follow the herd. And our talks resume back in this room at 1:45. So we will aim to start departing the faculty club by around 1:30 or so. All right. Thank you, guys. Thanks, Andres. That was great. Yeah. Absolutely. Yeah. I love the sort of, the intermediate range with the coordination issue sounds completely reasonable. Yeah, absolutely. No, it's sort of,
it's an interesting topic. I think.
Yeah.
The downside of being
So I guess some of the students come from
exactly right. For many countries, I think a big part of it too. I think I know this in the context of Bangladesh is that one of the reasons, by the way, why also there is a lot of, at least in the Bangladeshi context, a lot of what you were saying in terms of the heterogeneity of households and how much that matters, and how a big part of it is also the shadow economy. In part because a lot of real estate transactions have a big gap between book value and market value. And all of that gap is held in dollars, right? Because, right? So there's this whole, right? And so there is this, and then there's this whole